Tax Planning for Kiwis, Living in the UK, a guide to managing overseas investments. In this video, we'll explore a case study of managing overseas investments when moving between the UK and New Zealand. Meet a young Kiwi couple who recently moved to London. They plan to return to New Zealand in 2026 and want to avoid unnecessary tax traps. Let's explore their situation and the tax planning opportunities available. The couple left New Zealand in July 2023, have no permanent home there, and have been absent for over 325 days, making them non-residents for NZ tax purposes. They became UK tax residents in September 2023. Currently, their income is taxed under PAYE, so they don't need to file UK tax returns unless they sell investments. The investment picture. They hold US shares worth $500,000 via a New Zealand platform. These shares are now subject to UK tax rules. Dividends are foreign income for UK residents, and selling shares will trigger UK capital gains tax, CGT, calculated from the purchase price, so timing is critical to minimise liabilities. NZ tax implications. NZ doesn't have standard capital gains tax, but can tax gains if shares were purchased for resale. NZ's Foreign Investment Fund, FIF, rules complicate taxation for residents with overseas shares, but these don't apply while they are UK residents. UK tax planning timing options. Scenario 1. Selling before April 2025. If the couple sells their shares before April 2025, they can use the remittance basis to avoid UK tax on gains, provided the funds stay outside the UK. However, they will lose their personal allowance and CGT exemption, though they can avoid UK reporting if proceeds remain overseas. Scenario 2. Selling after April 2025 allows them to use the new 4-year exemption for foreign income and gains, which provides more flexibility without remittance conditions. This exemption applies for up to 4 years after arriving in the UK, and could suit their plans if they sell later. Tax implications of losing personal allowance. Losing the UK personal allowance increases overall tax liability. For example, on a salary of £40,000, losing the personal allowance increases tax by £2,174. At £80,000 salary, tax increases by £5,028. Over £125,040, there's no further impact as the allowance is already lost. Timing also determines when the couple needs to file a UK tax return. If they sell their shares before April 2025, they must register for self-assessment, file a tax return, and claim the remittance basis. If they sell after April 2025, they can register later and file under the FIG rules for the 2025-26 tax year. As you can see, early tax planning is essential. By consulting an advisor, the couple can time sales, use exemptions, and minimise liabilities in both the UK and NZ. The primary takeaway? Managing investments as a Kiwi in the UK requires thoughtful tax planning, so please seek advice to stay compliant and avoid unnecessary tax burdens. And with that in mind, for expert help with UK-NZ cross-border tax matters, give No Worries a call.